Hello, everyone. Thanks for attending to this very interesting webinar. And we are going to talk about the San Francisco Bay Area housing market. And it's a very, very challenging market indeed. And my name is SeeWing Yee from the Yee Real Estate Network. And my special guest is my friend, a local realtor. His name is Tony Bruno. Hello, Tony.
Hi, SeeWing.
Yeah, from Coldwell Banker at the Fremont office. Today, we are going to go over very good real-time housing data using the Redfin website with the many great metrics. It's real-time housing information. It's very dynamic. But and Tony Bruno has been a San Francisco Bay Area realtor for like more than 4 decades, right? I don't want to make you sound so old.
Going into my fifth year.
Maybe 5 decades. You've been doing this since 1980s. Am I right?
1988 to be exact.
80s, 90, 2000, 20, what? 5 decades.
Yeah.
You're not that old. You look good. You look good. By the way, Tony is I met Tony more than 25 years ago at the local gym in Fremont, and we are workout buddies for many years. But a few years ago, I moved away from Fremont into the Tri-Valley, 20 miles up the road. Anyway, so you and I been through many real estate cycles, and today we can talk about the Bay Area housing situation. And so you know the Bay Area very well. Obviously, you've been very successful, selling and selling a lot of homes for people. So anyway, so for those of you who are watching this presentation, I'm going to ask you to wait until the end until the end of this presentation. Because why? Because Tony going to share several cases of actual client situation, and it'll be very interesting to hear, right? Because normally the Bay Area, over the years, in every real estate cycle, the Bay Area is sort of the leading of the pack. Whatever happened, the housing, whatever happened in California and SoCal or NorCal, if you will, it kind of the domino effect go to the rest of the U.S. housing market, right? It's just so the California housing market over the years has been, volatile and very cyclical. So you take the good with the bad. So with that in mind, again, stay tuned toward the end. So you're gonna be glad you can stay the whole time on this presentation, on this video, because again, Tony gonna present several interesting client cases as it relates to what's going on in today's challenging real estate market. So without further ado, I'm going to share the screen. Oops, wrong screen. Here it is. All right. Can you see my screen? Redfin weekly housing data, Tony?
I can.
All right. So I'm going to go over each metric, and you'll feel free to interrupt me to go over to validate and to agree or disagree on some of the data as provided by the Redfin. So without further ado, Alameda County, for those of you who do not know, is located in the East Bay of San Francisco Bay Area. The population is around 2 million people, and it covers around 14 cities. So the East Bay is around 20 miles north of San Jose, and like 20 miles across the bay from San Francisco and the peninsula. And so, Oakland is part of it. It's part of the Alameda County, Fremont, Hayward, Dublin, and Berkeley, and a few other cities. Okay, so with that in mind, the first metric I'm going to use, I'm going to use the past 3 years, 2019, before the pandemic, 2020, 2021, and 2022. So let's look at year over year from June of 2019. The median sales price before the pandemic in 2019 was $865,000. Then we moved forward to 2020. There has been a slight increase. The median price in Alameda County is $80K, And then look at the huge gap from 2020 to 2021. There's a whopping 23% appreciation rate during this time frame, which is mind-boggling. And then from 2021 until May of this year, 2022, another whopping 17% appreciation rate. Now, so if you look at the big picture, for the people, for homeowners that purchased in the Bay Area in 2019, where the median price was $865K, now in June of 2022, this year, the value now is 1.26, the median sales price. Now, I'm going to ask you a question, Tony, since you know the pulse of the local market in the East Bay, Alameda County. So if the end of May of this year, the median price is 1.26, now then since the interest rate increased from 3 to 5.5 to 6%, we all know what's happening, right? It created a lot of chaos in the housing market nationally and locally. So how do you explain? I know nobody have exact conclusion on this kind of data, right? I'm just asking for your professional opinion, right? We cannot determine 100% accuracy based on this kind of short-term data. So do the best you can, Tony, throughout today's presentation.
You know what was different this June than the last 2 years? We were more open to travel. Fremont, the entire Bay Area, is very racially diverse. School gets out about the first week in June now. And what we find is a lot of people will go back to India. They'll go back, wherever they came from, and they'll be gone the entire summer. We've not had that the past 2 years. That's why we saw these big increases. Now that school's back in session, I can tell you, because I did an open house this past weekend, and open house attendance is way up. Again, interest rates have gone up quite a bit, and I think the buyers are still trying to absorb that. But the market, we're in correction mode, but it's still moving, provided you do two things: price it right, and the conditions got to be darn near perfect. But the prices are definitely down from their peak of, we felt it coming March, April, and May. Every time we were meeting with the seller, it's like, you got to do it now. And the ones that listened did very, very well. The ones that didn't listen are now listening, are wishing they would have performed 2 months back.
Yes, I absolutely agree with you. So now let me share with you my conclusion that I've drawn from 1.26 median price back in May of this year, and now it's all the way down to barely over 1 million. I suppose because of the interest rate rise, at the people cannot qualify to buy a higher price home like they did before the interest rate increase a few months ago. So therefore, this new medium sales price as of August 14, barely over 1 million, is the actual sales price, not necessarily a complete drop of almost $300,000 on, it's not a real value drop. It's just that the affordability factor only allow most people right now to qualify for the $1 million home instead of almost 1.3 back in May. Am I sort of correct in this matter?
Absolutely. I mean, everyone got spoiled by those rates, 2.5%, 3%. I mean, I've been doing this nearly 35 years, and those are historically low rates. And I kept telling people, they're not going to last forever. Jump in if you're going to do it. And now, even if they did jump in and buy it at the peak of the market, if they still have that 3% interest rate, they're still in a good position. Panic is the worst thing any homeowner can do in this type of a market. You just got to wait it out, and it's going to come back. They're all cycles. And we're just the beginning of this downward push.
I totally agree. So this trend, this 2022 trend on this black line here, is not a reflection that the price has dropped, by this much. It's just as a new sales price based on affordability factor. So this people should not, like you said, this is it's not doom and gloom. It's not,
Not
the world's not coming to an end. All right. All right, good to hear. All right, now the next metric, let's go over the active listings. All right, let's go over the active listings year over year. Let's see what are the trends. And the active listing right now, August 22 in Alameda County is 2,492, which is 28% higher year over year from last year, 2021. Now, if you look at right before the interest rate increase back in March, April, the active listings were 1,480, right? And now from 1,480 to all the way to 2,492. So it's almost like double the amount of listings that are in place. So can you have any quick comment on why this trend has the way it is?
Well, I'm not sure when you came down to Fremont last, but there's a ton of new construction, predominantly down by the Warm Springs BART station. There's about 6,000 new units down there. So that brings up that inventory. A lot of new construction. Drive Mission Boulevard and Hayward, you see it all the way down Mission Boulevard. New condos, new townhouses, high density housing. So that's bringing up those numbers. And again, those properties are now sitting because the rates have gone up. Again, you buy new, you get a slightly better rate, but people are just kind of buying cautiously now. But yeah, I do think inventory is going to continue to build. However, some people aren't going to sell right now because they think they're going to wait it out. So they're not going to put their homes on the market because they don't want to sell for less than what their neighbors did. So it's a real mixed bag out there right now. Very, very certain times. But again, people are still moving forward.
Yep, yep. So with that said, we have great comment. With that said, let's go over the new listings, the new recent listing month over month from July to August 14. So the new listings in Alameda County is 298. So that's like 30% lower year over year from 2021. So new listings have a downward trend ever since a few months ago in April. So as you can see, in April, the new listings on a month-to-month basis 416. Now in August is 298. So any comments on this new listings getting decreasing?
Again, a part of it is they don't want to sell for less than what their neighbors did. So if they don't need to move, they're not going to, at least in the resale market. Again, new construction is going to continue, but they're going to slow down as well if they're not selling the product.
Right, exactly, exactly. So the next metrics is very interesting, and this terminology might freak a lot of people out, but I'm going to clarify and explain this so people are being going to get educated and being informed, right? So the next clip is price drops. Okay, the price drop is not what people think. The price drop in the Redfin definition is percent of active listings with price drops, which is 7.6%, which is in the past month, past July to August of 2022. And but you see the upward trend in the price drop before the interest rate increase. You see almost there are no price drops at that time from the list price. But then ever since the interest rate has increased, we have seen percent of active listings with price drops. So 7.6, is a little bit of concern. So to me, when I see this data, this is only 1 month. The past few months is probably more than 7.6%. Maybe the past 4 months, am I right to multiply by 4 weeks? And if it's 4 weeks times 7% price drops, that could be 28% month over month in price drops. And did I read this correctly?
I think that's actually a little bit low on that number too. Um, I'm on the MLS daily, hour by hour, and I see price reductions. We used to see price increases. Now we're seeing price reductions, and they're pretty significant depending on the price point. But, when I'm talking to a seller about a reduction, I don't talk about $5,000 or $10,000. I talk about 5 or 10%. And it gets their attention, but it's like, you're going to do it, get it done. If you're going to reduce it, go big or don't reduce it at all.
So do you feel that the sellers or in the last few months, they did not get the memo meaning they fail to understand that demand has decreased due to interest rate rise, and they still want to list their price higher than what the market command. And then when their realtor, when their house does not sell in about 1 to 2 weeks, then perhaps they need to lower the list price to meet the lesser demand. Is that so? They have reduced the list price once or twice. So what have you seen lately among your clients the past three,
Well,
4, 5
the
months?
only property I've had to reduce was a townhouse that I have in the Irvington area of Fremont. Typically, Irvington's a hotbed of activity. We have reduced it $100,000. It's been on the market about 60 days now. We went out at 869. We're now down to 769, and we just get a handful of showings each week. I think we only had 2 over this past weekend, so it's we're seeing significant price reductions. Doesn't really get the buyers off the fence to buy. They still come in with the same complaints. It needs to be updated. It needs this. It needs that. And it's like, well, 6 months ago, this property was sold for $1 million. It's a great opportunity. It'll go back to that number at some point in time. Buy in now and stay with it for a while.
Right. So, so do you see any kind of concerns based on this trend line that we just talked about in terms of uh, uh, you think in the next few months for the rest of this year, you think the seller finally get the memo and they can list their price appropriately based on demand, and they're gonna make sure their house is in good condition, make sure they are not being unrealistic about their expectations.
Yeah, I make sure that they're 100% certain when they list the house that they've done everything they possibly can in their power to make the house look really good. We just put a little property in the market in Fremont, and we had the owner go through, get rid of the popcorn ceilings, put all new flooring in, and she's getting great traffic on that property. We also staged it. Again, 6 months ago, empty houses were selling, but now we need to have that staged look. We need to have that warm, fuzzy look when the buyers walk in.
Yeah, understand. Yep, that's what I hear. So for the next few metrics, I'm going to click them quickly. Pending sales. Then I'm going to click home sold. Then we'll see. Pending sale week to date is a mere 246, which is 31% lower than last year. So and then there's a pending sale. Then let's look at homes actually sold has decreased as well to 241 houses that were sold back this past August. Is a 35% reduction from 2021. So we see less homes being sold. So is that a concern? Is that what does it tell you about the pulse of the buyers and the sellers?
I think we might see a bit of a bump upward maybe the next month or so. And then typically October, November, we don't see any inventory come up. And if that continues, it typically continues to like February. And if the buyers are still out there, we could have an indoor inventory problem again. But again, with the amount of new construction out there, there's always going to be something for sale. But I think last year, again, I'm just going to go to Fremont. I think Fremont, we started out with 68 homes for sale January 1st. I mean, it's just single families, not including condos and townhouses. So again, I've always told sellers the best time to be on the market is the first quarter. And I think people that want to sell now, I'm almost going to tell them, let's just wait until February of next year and go out new inventory. Let's make some more improvements to your house. But again, keep it simple. Just make sure that it looks good.
Yeah, so 68 homes is not very many homes because Fremont, when I first moved to Fremont back in 1991, there was only like 180,000 people. Now it's probably like 300,000 people, and yet there's only 68 homes that were sold, recently. So tells you that there are not that many activities going on in Fremont. So let's look at medium days on the market. So medium days is 17 days. Is not so bad because before the interest rate rise, I suppose we're still seeing a little bit of multiple offers when the interest rate were less than 4% earlier this year, because the medium days back in March of this year were it's a little bit over a week
Yeah.
medium days on the market. Now the medium days is a whopping 17 days. Now it's not. It's still 17 days for me is nothing. It's still a very fast moving market. I mean, it's a pretty healthy market. So, what are your thoughts on the changes?
Well, none of this surprises me. Again, we have lots of stuff going on in the world, interest rates, COVID is still out there. I still think we're in a good market. It's just not as good as it once was.
Mm-hmm. Exactly. So, among your buyers, I mean, just from the best of your recollection, I mean, are they? I guess most of them are not doing all cash purchases anymore because perhaps the high tech stock options are drying up lately, and maybe perhaps the new buyers right now maybe they want to be more cautious. Maybe they're just putting 20% down payment, whatever. What has been the cases with your clients in the past 6 months this year?
Well, we see them writing really conservative offers. 6 months ago, buyers were going with no contingencies, no finance, no appraisal, no inspections. All the inspections were done in advance. But now we're starting to see appraisal contingencies go in. And I tell my seller, even if the buyer agrees to this price, it may come in below the appraised value, then they have an out. So let's price them right. Let's make certain it's going to appraise. But I do think that the buyers I'm working with, they know or they're hoping that at some point in time they can refinance the home they purchased. So they're not going in with that $200,000 over, $300,000 over the list price because that's artificial. And they need to have that 20% ownership to avoid PMI when they refinance. So offers are coming in. Actually, we just closed a property in Pleasanton last week. They had $30,000 over. Seller was thrilled. They only had one offer, and the buyer was only competing with themselves, $30,000 over. But again, they perceived it as a value, and if they bought a very nice home in a great location. But I think gone are the days of buyers just throwing in, two, 300, $500,000, $1 million over list price to buy a house. So I think we're going to see conservative real estate for quite some time to come.
I'm very much aware of that in the past couple of years. Now it's back hopefully to the healthy market. So the next metric is very important. Before I will click on this metric, the balanced market whereby supply of inventory equals demand is around 5 to 6 months, right? So that'll be is a good balanced market. Any kind of inventory that are less than 4 months inventory, that still makes it a strong seller's market. So with that in mind, so let's look at this very important metric, month of supply. So right now, month of supply in Alameda County is 10.4. So if 4 weeks equal a month, 4 weeks divided into 10.4 months, we still only have like 2.5 months supply of inventory. To me, that is very low. The supply of inventory is extremely low, historically low, still, believe it or not, relative to the demand. So 2.4 months of inventory. What are your thoughts on this? This.
Well, I'll tell you, 6 months ago, we were probably at 3 weeks. So being at 2.5 months, it's still a good number. Again, market's still moving, homes are still selling, but it is taking longer. I mean, it's not a normal thing for a home to sell in 7 days. It's just insanity. Everybody was just, they were panic buying, and now they just pulled back.
Yep, exactly. You're right. At the beginning of the year, the weeks of inventory is less than a month. So it's an extreme shortage of inventory at the beginning of the year. Now, it's been trending all the way down up to 2.4. So still seller's market, I believe, still extremely low inventory. A lot of homeowners. In fact, do you know 40% of all the homeowners does not have a mortgage at all? They are free and clear. And the remaining 60% of the people who have a mortgage in the nationwide, probably in the Bay Area also, they have massive amount of equity because of the skyrocketing of prices that has occurred during the pandemic the last 24 months.
Yep.
So yeah, that's what I see. So yeah, so therefore people are sitting on the interest rate, and a lot of people are not selling either now or later. So to me, over the long haul, over the long term, we're going to have persistent low, historical low supply of inventory moving forward, especially when interest rate comes down. Then we may see another real estate boom.
It'll happen. It will.
Yep, exactly. So people have to be patient. So let's look at average sale to list ratio. This means, I believe, the definition of average sale to list ratio is whatever is the final list price. The buyers bought the house, got it under contract. So the question is, did they get it at the list? Did they decide to get into contract at the list price or below list price? So let's look at the data. Average sale to list ratio. It has gone all the way down. At the peak of this year, the average sale to list ratio before the interest rate has risen was 1.17. That tells me, I'm sure Tony, you'll agree, that we're getting multiple offers the first quarter of this year, 2022. Not only that, multiple offers, sellers getting above asking and no contingency, no appraisal, whatever, right? So it's crazy. Since the interest rate has increased, we have seen that the actual sales price are very consistent, very close to the list price. In fact, which is right here, August of this year, the average sale to list price is 1.05. So still little bit, the sales price, actual sales price, still slightly higher than the final list price. So what are your thoughts on this trending data?
Well, actually, I just pulled up sold properties in the past 48 hours, and I run a pretty big search, but I'm going to pick on one property in Livermore. Actually, I showed the property, and it was listed at 1.1 million. It was a very nice house. It closed escrow on Friday for $1 million. That's a pretty significant price drop. And that's from list to sold.
Right. Wow. Yeah. Wow. I'm sorry. Can you repeat that again? This is interesting.
Yeah, it was a property in Livermore. It listed on June 20th, 2022 for 1.1 million, and it closed July 18th, 2022 for 1 million even. The sellers came down a whole $100,000. That's a very significant price reduction.
So
and
yeah, go ahead.
On the market 28 days before they accepted their offer.
So you feel that the list price of 1.1 is a little bit higher than the neighboring comps?
Actually, I showed the house. I thought it was well priced at 1.1. I thought it was well priced. I showed probably the first couple of days it was on the market, but my buyer, they're like, we'll keep looking. I think now when they see that closed at $1 million, because they were thinking about offering like $1.025 million, they might get off the fence and go out and try to buy something.
Yeah. So okay. So we're talking like 10% drop from the list price to an actual sales price. Yeah. Yeah.
That's significant.
Yeah. So how does a seller feel about it?
Well, if they want to move on, it's tough to say that they're going to pick it up on the other end, because if they're leaving the Bay Area, the Bay Area's got huge price swings. Taking it out, like if they went out to a Sacramento marketplace, they're coming down as well. But if they drop 10% there on a $700,000 home, it's only $70,000 they might pick up on that purchase. But again, if their ultimate goal is to get out of the Bay Area, it's still a good time to do it, no matter where they're going to go.
Yeah. Okay. Great, Tony. As we're concluding, 5 minutes left on this Zoom. Can you share a couple of extreme client cases? That one of them we just talked about a few days ago, just so the audience can get the pulse of about the craziness of the California housing market.
Actually, just this past month, my partner and I We've been reaching out. Actually, a client reached out to us. We met with them in February of this year, about February 1st or 2nd, and we went with the market analysis. It's a beautiful home in Sundale, really a nice property. And back then we were looking at 1.7 or 1.8. And now they've waited, life happens, things come up. They are looking more like 1.3, 1.4, 1.5 maybe on a good day. My partner just walked in. But in any event, another property in Pleasanton, nicest people you'd ever want to meet, but they are so slow to get their property to the market. Met with them again in February, a little more upscale property in Pleasanton. I think back then we were looking at 2.5, 2.6, and now we're looking at maybe 2 million. I'm thinking 1.9. So those are, again, it's not a loss. It's artificial. I'm calling it evaporating equity because, if you look March 13th, 2020, that was the COVID bombshell, right? We should have been in a correction mode, but it went up 25, 30%. So I think we're dialing, that's all going to evaporate, in my opinion, maybe more. But again, that's what we're seeing today in the Bay Area real estate market.
Wow, that is quite drastic. What you just said can freak people out. But Bay Area is a little bit different. Over the years, you and I know, right? It's a cyclical market. It's a boom or bust.
Yeah.
In the end, we always come to that. We always recover. So what's happening? This significant gaps in the Bay Area, in California for that matter, is very different than the rest of the nation. The rest of the other part of the country is really, really different. It's real estate is local. So don't. I warn everybody. Real estate is local. It's local down to the neighborhood, down to the street.
Absolutely.
Yeah. Don't, and the media paint such a negative picture on everything. That's how they report things, right? One more thing that really pissed me off, Tony, is that a couple of weeks ago, you and I have been doing real estate for several decades, right? You and I. I'm more on the investment side, out of state investments. Where about, even though I'm a California licensed real estate broker, I don't do real estate sales, in California. I just do out of state for my investors. But anyway, this new term really pissed me off. The news media and YouTubers, they're using the new term housing recession. There's no such thing as housing recession. It's a pure technical term. Recession is an economic type of recession. The dictionary does not have a word of housing recession. So it kind of pissed me off when the media create a new terminology just to scare people or just to have another way of another marketing tool they want to promote. So that's stupid.
Again, I've been doing this for, going on 35 years. It'd be nice to pinpoint when owning a home was more than just owning a home and became an investment tool. And I think that's why, people panic when their home goes down in value. Well, heck, you bought a house in Missouri in 1990 and you sell it today, you might make, 10% total gain on that time period. The Bay Area, the market's very volatile. It's the only place, I shouldn't say it's the only place, one of the few places where you buy a house, if you stick it out for 20 years, it's gone up in value exponentially. I can't even calculate how it's gone up. Go to my mom's house. She's been in her home since 1969. They paid $29,000 for it. If she sold it today, 1.8, 1.9, even in the declining market right now. So it's just crazy. But real estate, in my opinion, it's a great investment, but it's always been a long-term hold. And again, I use the term investment. It's a great place to raise your family first, investment second.
So Tony, here's the recap. So here's my thoughts. I'm sure you agree with me. Let's look at San Francisco Bay Area, even California for that matter, even the nationwide. Here's my thoughts. I do not see a real estate crash.
No.
I do not see a real estate bubble. I do not. I see a slight real estate correction. Now you have to understand, The word crash means different things to different people. The word bubble means different things to different people. The word correction means different things to different people. You have to get some clarity from each individual's opinion. A crash to me is 30, 40, 50% crash like we saw in 2008. It ain't happening in Bay Area or anywhere else because most people are not under stress. Most homeowners have massive amount of equity. They're not going to walk away from their homes under stress. So there will be no crash for that reason unless there's a nuclear war. Bubble, how do you define bubble? Maybe 20% reduction, for the next couple of years, that's a bubble. Correction, maybe 10 to 15% reduction temporarily. Yeah, to me, just a slight disruption back to the healthy, balanced market right now. We don't see any downside long term. So what are your thoughts about a crash, bubble, or correction? What is your take? What is your definition?
Well, I've always told people it cannot always go up. It gets to the point where so few people can afford to buy that it's got to reset. It's got to reset, and you get that new plateau where we're going to be. I think we're going to be downward probably into 2023. Again, it's going to be a soft landing, and then people they have unfortunately, well, I shouldn't say unfortunately. Fortunately, they can see what happened 2007 to 10, huge drop, but it came back and went even above where it started in 2007. So it's going to be the same thing again. Again, no one can time a market. My thought is we're going to be downward for at least another 6 months. And after that, who knows? But my thought is going to level out and take off again. And especially as buyers get used to these new interest rates, which are still favorable over the long term.
Yeah, exactly, Tony. I mean, today's interest rate, 5.5 to 6% from historical basis, is quite low.
Yeah.
People know no reason why people getting freaked out about it because, to me, if people can afford it, they can afford the new payment based on the higher interest rate. People have the down payment. If people if a buyer thinks it's the right time to buy, if they want to raise a family, long term, 7 to 10 years hold, they should be fine. Don't be paralyzed by fear or by this all these negative headlines that's going out there from news medias and YouTubers and stuff, right? So that's my take.
People ask me how I respond to the news. I said, that's simple. I don't watch it. Just do my thing. Yep. That's all we can do. If your life is still going good, you're employed. I mean, California, lowest employment rate since 1976. So there's still so many positive things that should keep real estate going for years to come. I think, again, this is a minor setback. We're going to get past this. And hopefully the kind of market we were in isn't healthy for anybody. So it'd be nice to see more of a balanced market. But you and I both know that really never happens. Not for long term anyway.
Absolutely, Tony. Well, I really appreciate your perspective. You've been a successful realtor in the Bay Area for a long, long time. So you have a pulse on the ground. So, Tony, how can people reach out to you if they want to buy or sell houses in the Bay Area?
Well, they can reach me on my cell phone. Is the best way. Again, my name is Tony Bruno. My cell phone 510-853-3849. Also work with an outstanding partner, Beth Wong, who have you not met yet, SeeWing. Very nice young lady. Her number is 510-325-8317. She's a little newer to the business, so she still has this youthful enthusiasm, which I do as well. I've never lost that, but we're a great team now. So feel free to give us a call anytime.
Very good, Tony Bruno. Thank you so much. I really enjoy your perspective, your wisdom, and your knowledge. And thank you so much, Tony. You're my good friend for more than 25 years. We're gym buddies.
Come on back.
Yeah, I still work out almost every day in up the road.
All right. SeeWing, thanks for having me on. I appreciate it.
Thank you so much. Pleasure. Bye-bye.